We all run after quick bucks. एकदम ताबड़तोड़ return चाहिए हमें, like money put in and money back with profits. Isn't that true? Wouldn't this be a wonderful world if this was true? Wouldn't that be nice? Think. The demon has spotted an opportunity.
My new friend Kevin Doyle showed me how you could leverage 2.5 times your cash at a day trading firm. I've been upping the dose for over a week.
Opportunity to tickle your emotions.
It seemed to cut my learning curve.
And capitalize on the mindset that you have developed. It now has the magic pill.
The CEO was just indicted.
But not for the big fat defense contract he bribed his way into. That's still
That
on.
makes you
Should be
believe
announced
that you
next
have the
week.
clarity to see beyond others. You start to believe that you can capitalize the small ups and downs in the stock market, fluctuations.
It seemed to cut my learning curve.
You start to believe you're on top of the world.
I didn't go in. I wanted to walk, move, digest, ingest.
There are moments in life, moments when you know you've crossed a bridge, your old life is over. Van Loon was my bridge. I finally had my shot. Wall Street would provide my nest egg. But then how far could I go? CEO? A global force? Maybe president? Time somebody shook up the free world and got things done. Suddenly, there was another skip. How had I gone the last 20 years?
Think again. Today we'll uncover some of the biggest blunders we make in investing. Biggest blunders. Not just that, we'll try and find out how we can avoid all of them. So like this video and subscribe this channel so this video can reach a lot of people. Investor, if you listen to this word, not too long ago, maybe 20, 30 years back, you would portray somebody with a suit and a boot on, with a tie, with a pen, pencil, with lots of financial papers, numbers around him, computers, trying to figure out a complex mathematical calculation, and at the end coming up with an award-winning stock or an award-winning investment avenue. That was an investor. That was 20 years back. Not that much today. Today you all have a smartphone, few apps that helps you just punch in few details, that gives you a lot of information right on your palm, and you can start your investment journey. Things have changed. Times have changed. With that came a huge loads of negativity. With that came traps. The trap of distractions. What are they? The spicy columns. The spicy columns on your newspaper, on the social media sites, on the news forums that you see. Flashy news. Do you think these people, they think about your portfolio? They do take care of your portfolio? No. All they need is TRPs, their own profits. Now with the rise of the internet and this internet information era, there is always something to worry about. Look at the major events that has gone down the world. Brexit, pandemic, Ukraine crisis, COVID. All of these are panic buttons. And the news journals, the news agencies, they have capitalized on it. They start with the doom and the gloom because bad news sells fast. They spread like a virus. And the more they spread, the more the TRP is for the news channels. They make people nervous. They make people afraid. They make you and me feel afraid of our investments. But on the other hand, if you see, the market is more resilient than what these people, they make us feel. They try to make us feel. Isn't it? The data says so. Since the year 2000, 23 years back, there has been a panic situation every year for the last 23 years, and yet the market, which was at around 4,000 points in the year 2000, it has come down. It has come to somewhere around 65,000 now. That's 15 times of your investments. But yet, these people, these panickers, they never miss a chance to press your panic button. Market has always come back as a winner in this fight. It has always been resilient. And on top of that, the efficient market hypothesis tells us that whenever there is a panic, the market has already taken its price into consideration. The market has already taken its effect into consideration. So what is there to be afraid of? But no, we think of selling off our holdings and accumulate the capital and enter at the very bottom. Almost every one of us, we feel the same. But are we successful all the time? Do we do it? No, because no one knows where the market is going to bottom out. You know how it feels? With every dip, you will feel, okay, fine, this is it. Maybe this is the bottom. With every little push-up, you'll find, okay, fine, this is it. Maybe the market has bounced back. That is the dilemma. We see the resistance now. We go all guns in. We put in all our money. What happens if the market goes down further? That is a disaster, isn't it? Timing the market is impossible. And it becomes even more tempting at the time of volatility. And when you try to do something which is impossible, what comes with it is disaster. Now, I would want you to focus on an article from Hartford Funds. Here it is what it says. If you missed the market's 10 best days over the last 30 years, your returns would have been cut in half. And missing the best 30 days would have reduced your returns by an astonishing 83%. Wow! And you're still running after timing the market? You're still running after capturing the small volatility in the market, capturing the ups and the downs in the market? While doing so, if you miss 10 instances, not in a day, in 30 years, if you miss 10 instances in 30 years, your investments would have reduced by half. And if you miss 30 instances in 30 years, that's one instance in a full year, you lose 83% of your returns. Is it a joke? You people still strive and run after trading? You people still try to time the market? You think that's wise? Now, it's important to understand that not all stock that falls in a bear market is a loser. But all stock that falls because of improper business justification, bad management, and not so good future business opportunity is definitely a loser. This is a very subtle point of difference. And if you hold on to these investments, if you hold on to these losers, that's where you make a mistake. And that's what people make the most. They hold on to the big losers. This is fatal, be it in the down market or in the up market. If you're holding on to the losing stocks, that is fatal. You do not have to capture the fluctuations, but you have to completely come out of the holdings, completely wipe off. Completely come out of the holdings of a bad stock or a bad investment. If there is no future in that company. That is it. That is the only criteria which you should be checking. And the biggest mistake is not diversifying. Sometimes you hear about a company that keeps growing. The share price keeps growing. It sometimes becomes tempting for us to invest all of our money into it and gain the profits, capture the profits. You have to be very, very cautious because these can be bubbles and bubbles burst. Just like the tech bubble burst after the millennium. Having a diversified portfolio reduces this risk. also helps you get a stable returns for a very, very long period of time. So as a general rule of thumb, the more investments you have in the equity market, the more volatile it will be. And consequently, it will be exposed to a greater risk. Consequently, on the other hand, if you have more safer investments like the government bonds or the AAA rated bonds, they are more safer, but the returns would be much lower, but then your capital will be very, very safe. This is the beauty of diversification. This beauty is that if one bad stock starts falling, I know it's time for you to come out of it, but before you identify that, others would negate and balance out the negative effect of that stock. Also, if you diversify between stocks and bonds, if the entire stock market is in the downfall, the bond market tends to go on the reverse direction. So your entire portfolio balances out. So what is it that we have to infer from this? Number one, do not take hasty decisions. Judge, has the event actually devalued your investments? Or is it just a minor shock in the market? Did the company lose its potential because of this? Do you have enough diversification? Check if you have other investments that will cover up for this falling value. And sell only the losers. Don't sell off everything. Diversify and invest in good, strong, fundamentally strong companies. Because the truth is, the market recovers quicker than most people would anticipate it to be. So it's most important to wait and weather the harsh conditions that the market is going through right now. That's all. Endure. Hope that helps. See you again in the next video. Till then, SG signing off. Goodbye.